Picture this right now in February 2026. Unemployment just eased to 4.3% in the latest BLS data. Inflation cooled to around 2.4% CPI. Headlines everywhere cheer soft landing and resilient economy. Your 401k might even look decent, no massive layoffs blasting across the news. So things feel okay, right? Wrong. Dead wrong. Beneath the surface, serious warning signs are flashing, and almost everyone is ignoring them completely. Consumer sentiment is crushed. Michigan prelim February at just 57.3, still 20% below last year. Conference Board confidence tanked to 84.5 in January, lowest since 2014. The leading economic index keeps declining, signaling slower growth ahead. Tariffs are quietly slamming import costs, with over 50% pass-through hitting your wallet hard. The job market's stuck in this creepy low-fire freeze. SOM rule edging at 0.30, not triggered yet, but rising. And recession odds still sit between 20 to 35% depending on who you ask. New York Fed 20%, Polymarket 23-26%, JP Morgan 35%. This isn't clickbait fear. History proves the nastiest crashes always creep in when complacency is at its peak. When bad news gets dismissed and everyone chants, it feels different this time. In this no-fluff breakdown, I'm exposing the hidden cracks the mainstream skips. The split economy tearing America apart, the quiet job freeze, policy wildcards like tariffs and debt, the AI hype masking weakness, economist groupthink, consumer exhaustion, and the real risks if it all snaps late 2026. Then I'll hit you with the truth on why so many are blind to it, recency bias, false hope from Fed cuts and tech booms, and finish with your actionable survival plan. How to build emergency cash, diversify smart, kill bad debt, upskill fast, cut costs without suffering, and stay ahead without panicking. If rising costs, job worries, or market uncertainty keep you up at night, this is the wake-up call your wallet needs. Stick with me. It could save you big in 2026. Smash like if you're ready for the unfiltered truth. Subscribe and hit notifications for more real econ breakdowns, and drop in the comments right now. Do you think a 2026 crash is coming, or is it all overhyped? Let's get into it. Hey everyone, welcome back to my YouTube channel. I'm Sammy, and if you're tired of surface-level news telling you everything's fine, while your grocery bill and rent say otherwise, this video is for you. Today we're exposing the 2026 economic crash warning signs everyone ignores. We're smack in the middle of February 2026 right now, and headlines are still cheering a soft landing. GDP growth projections are holding around 2 to 2.5% for the year, unemployment steady at 4.3% from the latest January BLS report, and inflation's cooled. CPI hit 2.4% year over year in January, the lowest since May last year. Feels okay on paper, right? But that's exactly the trap. The biggest crashes always sneak up when complacency peaks, and right now, the signals are whispering trouble while everyone looks the other way. Let's kick off with the first ignored sign. The broken warning signals that used to scream recession early. The Conference Board's leading economic index, normally one of the most reliable predictors, keeps declining. It fell again recently, with the 6-month drop moderating but still pointing to slower growth ahead. Weak consumer expectations and soft new orders are dragging it down, even as labor bits like unemployment claims offer minor support. History shows these leading drops precede real trouble by months, yet people dismiss it because stocks are riding AI hype and the market's climbing a wall of worry. The LEI's not flashing full red alert yet, but consistent weakness like this has called slowdowns before. Ignore at your peril. Next up, the split economy tearing America in two. Big tech and wealthy households are still booming. AI investments keep pouring in, stock portfolios look fat for those at the top. But for the average American, consumer sentiment is absolutely tanked. The University of Michigan's preliminary February reading inched up slightly to 57.3, better than January's 56.4, but still about 20% below last year's levels and feeling near pandemic lows in vibe. Meanwhile, the Conference Board's Consumer Confidence Index collapsed to 84.5 in January, the lowest since 2014, with expectations dipping below the recession warning 80 threshold. People are exhausted. Higher costs for basics like housing, healthcare, and electricity are sticking around despite headline inflation cooling. This is classic stagflation light. Slow growth mixed with stubborn prices. The bottom half of the economy is dragging hard, and when everyday consumers finally crack from affordability fatigue, businesses feel it fast. Spending drops, hiring freezes, the whole cycle turns. Sign 3. The quiet freeze in the job market that's hiding in plain sight. Unemployment's holding at 4.3%, but dig deeper. It's a full-on low-hire, low-fire world. Companies aren't laying off in masses yet, no dramatic headlines, but hiring's frozen in most sectors outside health and essentials. Job growth's anemic, with payroll revisions often showing overstatements from prior months, and immigration slowdowns are tightening labor supply even more. Economists keep warning that this momentum slowdown hits long before official unemployment spikes big. The Somme rule, Claudia Somme's famous recession trigger, is edging up to around 0.30 as of January data. Not triggered at 0.50 yet, but rising steadily. People ignore it because there's no mass layoffs on TV screens, but this freeze is textbook pre-recession setup. Companies hoard workers instead of expanding, waiting for the shoe to drop. And don't sleep on the policy wildcards still looming large. Tariffs are jacking up import costs. Effective rates are way higher now, with pass-through to consumers estimated over 50% in many cases. That means goods inflation could re-accelerate, potentially forcing the Fed to pause any further cuts or even rethink easing. Add ballooning national debt limiting fiscal wiggle room, risks of government shutdowns from policy fights, and ongoing trade tensions. It's a powder keg. Forecasts warn tariffs could shave growth while pushing core PCE inflation toward 2.7 to 3% or higher if pass-through ramps up. Yet headlines spin it as protectionism wins, totally ignoring the real pain hitting everyday wallets. These aren't flashy, breaking news headlines. They're the slow-burn cracks spreading under the surface. Ignore them long enough, and 2026 could turn ugly fast. Slower growth tipping into contraction, jobs getting scarcer, markets correcting hard. But we're just getting started here. Stick around for Chapter 2, where we uncover why everyone's sleeping on these dangers and the deeper risks building beneath the surface. Hit that like if this is hitting home, subscribe for the full breakdown, and drop a comment. Which sign worries you most? Let's keep the conversation going. Why is literally everyone ignoring these warning signs? Why are headlines still pumping soft landing and resilient economy when the cracks are right there? It boils down to recency bias, false hope, and a whole lot of shiny distractions keeping folks complacent. First off, the AI bubble is fueling massive denial. Capital spending on AI and tech is basically the only thing propping up GDP right now. The rest of the economy's flat or trending down. Experts call it a zombie economy. One sector's partying hard while everything else struggles. Stocks keep climbing a wall of worry. S&P hitting records on AI hype. But fundamentals? Weak. Leading indicators like the Conference Board's LEI keep declining. Consumer expectations tanked. New orders soft, lumber and freight plunging. Yet Wall Street rallies because AI feels like the next big thing. History says bubbles pop, and when they do, corrections get brutal. Some forecasts whisper S&P pullbacks to 4,200 to 4,500 if non-tech demand stays sluggish or tariffs bite harder. Second, straight-up economist groupthink at dangerous levels. Surveys show almost no major economists calling for outright recession in 2026. That's rare. Last time we saw this kind of unanimity? Right before the 2008 crash and the 2000 dot-com bust. Recession probabilities are all over the map right now. New York Fed's yield curve model at around 20%. Goldman Sachs just dropped theirs to 20% from 30%, citing stabilizing labor. But JP Morgan still holds at 35% for US and global, with others whispering 30 to 48% if labor cools more or policy shocks hit. The consensus? May year or modest growth at 1.9 to 2.5% GDP. When experts all agree it's fine, or at least not crashing, that's your biggest historical red flag. Complacency breeds surprises. Third, policy optimism overriding the ugly reality. The Fed's holding steady after late 2025 cuts, projecting PCE around 2.4 to 2.7%. Growth rebounding to 2.2 to 2.3% thanks to fiscal easing, deregulation, and maybe some tax cut boosts. Sounds great on paper, but tariffs and immigration crackdowns are massive wildcards still playing out. Effective tariff rates spiked, passed through to consumers over 50% in estimates. Goods inflation creeping back, potentially pushing core PCE toward 2.7 to 3% or higher if more costs hit wallets. Reduced immigration tightens labor supply. Higher wages in spots, but slower overall growth and weaker job ads. National debt's ballooning, limiting any big bailout room if things tip. If inflation reaccelerates while the labor market cools, like the low-fire freeze we've been in, the Fed gets stuck. No easy cuts without fueling prices, choking consumer spending, especially for middle and lower income folks already exhausted. And the scariest blind spot? Delinquencies creeping up quietly, more households living paycheck to paycheck than before the last big downturn. Affordability structurally broken. Housing, healthcare, basics, and momentum in jobs is rolling over. Hiring's less aggressive. Revisions showed 2025 way weaker than thought. Hundreds of thousands fewer jobs added. Youth unemployment high, long-term unemployed at records. Yet no mass pink slips on the news, so it feels stable. That's the danger. The freeze breaks suddenly when confidence cracks further. This whole blindness comes from comfort zones. Your 401k looks decent if you're in tech/AI, no layoffs in your circle yet, so why worry? Recency bias says no crash yet, so no crash coming. Plus, Fed caution and policy tailwinds give false hope. But the ignored side, consumer exhaustion, policy shocks, hidden labor weakness, is winning quietly. Cracks spread fast. Weaker spending leads to slower hiring, deeper retrenchment, maybe tipping slow growth into contraction late 2026. The breaking point: what could actually happen if these ignored signs finally snap? And your no BS survival plan to come out stronger. This isn't doom and gloom. It's preparation so you're not the one scrambling when things shift. Worst case late 2026 scenario. The low-fire freeze cracks wide open. Tariffs keep pushing costs through. Pass-through already over 50%, with forecasts saying core PCE hits 3% or higher as more hits consumers. That forces the Fed to stay cautious or pause cuts. Inflation sticks stubborn around 2.7 to 3%, and consumer exhaustion finally bites hard. Growth slows from current projections. Deloitte sees 1.9%, CBO around 2.2%, Goldman 2.5% Q4 to Q4. But if tariffs shave another 0.4% off GDP and labor cools more, we tip into mild contraction. Unemployment climbs to 4.5% average. Many forecasts peg it there. Maybe higher in retail, manufacturing, non-AI tech. Job losses concentrate where hiring's already frozen. Youth unemployment spikes further. Long-term unemployed grows. Market correction hits. S&P pulls back 10 to 20% if AI hype fades and non-tech demand stays weak. Not a 2008-style meltdown, no massive banking crisis, but painful. Tighter credit, slower wage growth, higher everyday costs squeezing families already paycheck to paycheck. Recession odds aren't screaming yet. Goldman at 20%, Wall Street Journal average 27%, JP Morgan 35%, some still 30%. But they're not zero, and the risks stack if policy wildcards, tariffs, immigration slowdowns, debt limits bite harder. The SOM rules at 0.30 as of January, not triggered at 0.50, but edging up with revisions showing 2025 way softer. If consumer spending flatlines like recent retail data hints, it cascades. Weaker demand, slower hiring, deeper slowdown. Late 2026 could feel like stagflation light turning real. Growth stalls, prices creep, jobs get scarcer. But here's the empowering part: you control a lot. You don't have to be a victim of ignored warnings. Start your survival plan today. Emergency fund lockdown. Build or boost to 6 to 12 months of essential expenses in a high-yield savings account. Rates are still decent. Cash gives you breathing room if layoffs hit or credit tightens. Don't rely on home equity or cards. They dry up fast in slowdowns. Diversify investments smartly. Don't ride AI/tech all in. Bubbles correct hard. Shift portions to defensive plays. Bonds for stability, utilities/healthcare stocks that hold up in slowdowns, even gold if inflation reaccelerates, semi $5,000 plus in crisis vibes. Balance growth with protection, rebalance quarterly. Debt purge mode, attack variable rate debt aggressively, credit cards, adjustable loans. Fixed low rate mortgages? Keep them. Avoid big new borrowing, cars, homes, until signals clear. Lower debt means lower stress if rates stay high or income dips. Career future-proofing. Upskill now in resilient fields. healthcare, trades, essentials that resist AI/automation. Get certifications, build side hustles, network. If job market freezes more, you're the one companies keep or hire first. Cost smart living. Tackle tariff-impacted prices. Buy American-made where feasible to dodge hikes. Go energy-efficient to beat electricity costs. Shop healthcare/insurance aggressively. Cut non-essentials without misery. Small wins add up. Stay vigilant, not panicked. Track monthly. Unemployment revisions, LEI updates, consumer sentiment, tariff news. Adjust if signs worsen, but don't knee-jerk sell on dips. History favors the prepared over the reactive. Bottom line. The economy might muddle through at 2% plus growth if tariffs ease pain or AI keeps carrying, but ignored cracks raise real risks of a rougher 2026. Prepare like recession odds are higher than headlines say, because caution wins long-term. You've got the full roadmap now, the cracks, the blindness, your plan. What do you think? Mild slowdown, full recession late 2026, or soft landing? Drop your biggest worry or prep step in comments. I read every one. If this fired you up to protect your future, smash like, subscribe, turn on notifications. We drop deep econ breakdowns weekly with no fluff. Share with anyone sleeping on this. Thanks for sticking through all 3 chapters. Stay sharp, build that buffer, and I'll catch you in the next one. Peace.